The previous one, previous one I have, sir. I'll check 1 second.
Yeah, just check.
Last year FR material I have, sir.
Yeah, not an issue. 20 to 23, no?
Yes, sir.
I'm also having the same. Okay, shall we start?
Yes, sir.
Okay, what I will be doing is I'll be starting with the introduction part, that is your chapter number 1. And then I will be moving on to chapter 6 and 7. So I'll be doing this,
Okay.
then chapter 6, chapter 7. And then I'll come back to chapter number 2. I will take up chapter number 5 because they are connected topics. So all the connected topics I'll take together. And then after doing chapter 5, we'll take up chapter 3 and 4.
Okay, sir.
Okay, have you given your FR paper before?
No, sir.
So it will be the first time. Have you given any exam before, ACCA?
This is my first exam, sir.
Okay. So first of all, you should be aware of the format of the ACCA papers. Are you aware of the formats and all? You have the MCQ questions, then you have lengthy questions, which you will be supposed to answer. And basically what you are supposed to focus on and concentrate is the concepts. So all concepts which are there, don't study from the Indian type of study where you by heart something without understanding, mug up the definition. Don't do that because definitions mugging up is not going to be there anywhere in the paper. Basically, you are supposed to have knowledge of the concept and application of knowledge. So that is what is the skill level. Skill level means your skill, your ability to apply the knowledge that you have gained in the different scenarios. So you will be having case studies, for example, right? So application of the skill for solving practical case studies, that is what is going to be important for you. Now, starting with the first part, that is preparation of financial statements. First of all, we have to know what are the financial statements from the international point of view, what we call those financial statements. The terminology will differ, the language will be different, and your interpretation of the various financial statements also is going to be different from the Indian context. So starting with the first one, that is the type of financial statements that we are going to have. Most important thing is that in your ACCA papers, they expect you to remember all the accounting standard numbers. So whenever you're writing anything in relation to any accounting standard, your accounting standard number has to be written first. And then the explanation will follow. So now we are doing IAS 1. IAS 1 is International Accounting Standard 1, which deals with presentation of financial statements. Now, in the presentation of financial statements, they give you a list of all the statements that are required to be prepared. Like when we are preparing final accounts, we have trading account, profit and loss account, balance sheet, cash flow statement. Likewise, they also have their set of financial statements, but There is nothing like a trading account or a profit and loss account. There is nothing like a balance sheet over there. Okay, so they are having a different set of statements that they use. Now, the first one is called as a statement of financial position. It is actually a balance sheet only, but they don't call it as a balance sheet. They call it a statement of financial position. So I will also refer to that as a SOFP. SOFP means statement of financial position. You have to know the short forms also.
Yes.
So SOFP stands for statement of financial position. Then you have the statement of profit or loss. We normally write profit and loss. It is actually wrong. It is statement of profit or loss. And see, it is here it is or, here it is and other comprehensive income. This other comprehensive income, we call it as short as OCA. So a statement of profit or loss and other comprehensive income, or you can have a statement of profit or loss plus a statement showing other comprehensive income. So now what is the difference in these two? The first one says and comprehensive income. The second one says plus a statement showing other comprehensive income. The difference is that here this will be one single statement. One single statement, which is having both of them in one single statement only. You have the statement of profit or loss in the first part, and the second part will be called as the other comprehensive income. So it is like above the line and below the line. It is one single statement. The second one is they are saying plus a statement. So there are two statements here. There are two statements here. And the first statement is called as statement of profit or loss. The second statement is called as statement showing other comprehensive income. Okay, so two statements. Separately, we prepare statement of profit or loss and we prepare statement of other comprehensive income. So either you will prepare it, what they want to say is that either you will prepare it as one single statement or you will prepare it as two separate statements. Then you have statement of changes in equity. This statement of changes in equity is going to show all those things which are concerning owners of the business, shareholders of the business. So the share capital, the share premium, the retained earnings, the revaluation surplus, the OCI, that is other comprehensive income, all that will be shown over there, the balances. Just like we have an item called as a reserves and surplus in the balance sheet. They don't have a separate statement like a reserves and surplus. They have a statement called a statement of changes in equity. So what is the short form for this? It is SOCIE. Statement of changes in equity. This is called as SOPL. So I will be making use of all these short forms. SOPL and OCI. And then we have SOCIE, that is statement of changes in equity. Then we have statement of cash flows, that is SCF, statement of cash flows, SCF. And last we have accounting policies and explanatory notes. So that means there are 5 items which are included in the set of financial statements. 5 items which are in the set of financial statements. The first one is the statement of financial position, which is similar to our balance sheet. The second one, SOPL and OCI. The third one, statement of changes in equity. The fourth one, statement of cash flows. And last one is not a statement, but it is accounting policies and explanatory notes to the financial statements. Okay, so this forms your IAS 1, that is different types of financial statements which are included. Now, coming to certain things called exceptional items. Of course, now we don't have anything called as exceptional items as a heading in the statement of profit or loss. But nevertheless, we have to know what those exceptional items are. So exceptional items, you can see that I have underlined, is the name often given to material items. So wherever I have underlined, please see that in your book also you underline. These are important terms, important words. Material items, material, significant. So exceptional items means significant items of income and expense of such a size, nature, or incidence that disclosure becomes necessary in order to explain the performance of the entity. For example, you have for inventory valuation, that inventory will be valued at cost or market price, whichever is less. Now, suppose we are following the market price and that market price is the lower of the two. Your cost is given as $10,000. Your market price is given as $7,000. So you are going to show $7,000, which means that you are going to write down the stock by $3,000. So that has to be written in the profit and loss. Statement of profit or loss, you will have to show that item. But along with that, you have to give an explanatory note also, because these are exceptional items which are significant in nature because they are a part of the accounting policy. Right? So it is a part of the accounting policy that you measure the inventory either at cost or market price, whichever is lower. So that is how we show this particular item. It is called as exceptional item. And it is exceptional because it is significant. It is having a very important relevance in your financial statement. So disclosure becomes necessary. So either it is including an item in the standard statement of profit or loss, or disclosing the nature and amount in the notes. That is your financial notes. Examples they have given here. Writing down of inventories to net realizable value, NRV. Impairment of property, plant and equipment, that is decrease in the value. Impairment means decrease in the value of property, plant and equipment. Restructuring cost, that means if you are restructuring your business, that is reorganization of your business, then in that case, whatever is the cost, legal expenses, etc., that will be a exceptional item. Gains or losses on disposal of non-current assets. Non-current asset is a term that they use for fixed assets. They don't call it as fixed asset. You should also not call it as fixed asset. It should be referred to as non-current assets. Okay. So non-current assets, when they are sold, the profit or loss that arises on their sale, that has to be shown in the statement of profit or loss. Then you have discontinued operations. For example, a part of the business is discontinued during the year. Then whatever are the results of that particular business for the year, that has to be shown separately. It should not be mixed with the continuing operations. So discontinued operations will be coming separately. Then same way, litigation settlements, if you are having any outstanding disputes, legal disputes, which you have settled either out of court or through the court, then the expense will be coming in the statement of profit or loss. You have to give the explanatory note for that. Then statement of financial position, the format they have given. You can see that it is in the vertical format. It is never in the horizontal format like we have, like assets and liabilities. They have it in the vertical format, one below the other. They start with the assets, and in the assets, they have non-current assets, that is fixed assets first. In that, they will be having property, plant and equipment. So like what we do in India, we write plant and machinery, furniture and all these things. They don't write like that. They give just one common heading, that is property, plant and equipment. That is called in short as PPE. Property, plant and equipment. Then they have investments. Now these investments are long-term investments. And then they have intangible assets like patents, trademarks, franchises, brand, patents, okay, trademark, etc. The next after that is current assets. Current assets are short-term assets which are receivable within a period of 12 months or the working capital cycle, whichever is longer. Okay, in that you can see the first one, that is inventories. We don't use the word stock. So avoid using the word stock, because in international language, when you say stock, it means shares. Okay, so stock means shares. They don't call it as shares, share capital. They call it as, they don't have equity shares. They will call it as ordinary stock. They will not call it as preferred shares. They will call it as preferred stock. Okay, so like that, there will be difference in the vocabulary, differences in the terms, how you address them. So we will have inventories. Inventories are inventories of raw materials, inventories of work in progress, inventories of finished goods. Then next item you can see there is trade receivables. Again, we don't have anything called as sundry debtors. We don't have anything called as bills receivable. So together they are called as trade receivables. So never mention anywhere when you are preparing a balance sheet, sundry debtors, never mention the word bills receivable. It is always trade receivables. Then you have cash and cash equivalents. And last item you can see that I have circled over there. It is called asset held for sale. I will come back to this asset held for sale when we are doing the chapter number 2, which is on governed by IAS 16, that is property, plant and equipment. I'll come back to this particular point. So remember that, just circle that and keep it so that we can come back to it at a later stage. That is assets held for sale. So then you have your total assets, that is non-current plus current. You have your total assets. Then next item is equity and liabilities, starting with capital and reserves. You have share capital, you have retained earnings and other components of equity. Now, this other components of equity will come from where? It will come from your statement of changes in equity, SOCI. Other components of equity will come from SOCIE, statement of changes in equity. Then we have non-current liabilities. We don't have anything in the balance sheet called as long-term liabilities. They are called as non-current liabilities. In that, you will be having your long-term borrowings, deferred tax, debentures. Okay, you can have debentures here. And bonds, long-term bonds which are there, that also you can have. So debentures, or bonds. Okay, so these debentures or bonds can be coming in this particular part, that is long-term non-current liabilities. Then we have current liabilities. Now again you can see that it is trade and other payables. So it is not sundry creditors. We don't have anything called as sundry creditors. It is called as trade and other payables. So sundry creditors, if you are having, what we will call them as trade creditors or trade payables. And other payables, that means other than your normal suppliers. Then you have short-term borrowings, current tax payable, that is current year's tax payable, and short-term provisions. Now, IAS 1.
Sir,
Yeah.
I had a doubt.
Yeah.
What do you mean by deferred tax, sir?
Deferred tax is sometimes your actual tax liability is more than the current tax liability that we calculate. So there is a difference. Either you are paying more or you are paying less. So because of that, we have something called as a deferred tax asset or a deferred tax liability. It can come on either side of the balance sheet. So when we are doing taxes, that I will explain to you at that time. Okay. Yeah. What is a deferred tax? I'll give you a simple example just to make you understand what is the concept. Say, as far as income tax is concerned, they follow, the income tax authorities allow only written down value method of depreciation. But our company follows straight line method of depreciation. Okay. So what may happen is that we are charging depreciation as per straight line method. Amount of depreciation will be higher, the profit will be lower. Whereas, as per income tax calculations, written down value method, depreciation is less, profit is more, therefore tax is more. Okay, so there is a difference between the accounting profit and the taxable profit. As a result, there is a difference in the calculation of tax liability as per accounting profit and as per taxable profit. That difference is called as a deferred tax. So it can be a deferred tax asset or it can be a deferred tax liability. Okay. Coming to the latter part. IAS 1 requires an asset or a liability to be classified as current. Now, why do they use the word current? So they are explaining that if it will be settled within 12 months of the reporting date, or it is part of the entity's normal operating cycle, and I would like to add over there, whichever is longer. So what we have to add over there? Whichever is longer. Now, what do we mean by this? It means that either it is a period of 12 months or it is the reporting cycle, the operating cycle, whichever is longer. Operating cycle is the time that you require to purchase raw material, convert it into finished goods, sell it in the market, realize the cash from the customers, and pay the cash to the creditors. So that entire cycle is called as operating cycle. The time period of purchasing raw materials, manufacturing finished goods, selling it to customers, customers making the payment in cash, that cash being paid to suppliers. Okay, so there will be a time period for the entire cycle to complete. That is called as the operating cycle. So sometimes, so mostly the operating cycles are less than 12 months. But suppose you have operating cycle more than 12 months, suppose it is a 14-month operating cycle, then it is 12 months or 14 months, whichever is longer. So it will be 14 months. Okay. Then within the equity section, we had said now that one part is there, which is going to be SOCI, other components of equity. So what they are saying is that within the equity section of the statement of financial position, other components of equity will include revaluation surplus, share premium, investment reserve. That means these are all undistributed profits which are available for shareholders. Okay. Now, how that statement of changes in equity looks like. We have this format over here. So you can see that in the first column, we have got share capital. In the second column, we have got share premium. Third column, revaluation surplus, which is a capital profit. Then the retained earnings, which is a revenue profit. And the total of these four columns will come as a total equity. Okay. How do you start with this statement? It is opening balance as on 31st December. Now, one more thing that you have to remember. In the absence of information, if nothing is given in the question, your reporting date, they call it as reporting date. Your reporting date is always December 31st of the year. Because most of the companies, most of the Western companies, they follow the calendar year. We follow the financial year, that is April to March. They follow the calendar year, that is Jan to December. So in most of your cases, when nothing is mentioned in the question, we will assume that reporting date is the last date, December 31st. If not, then they will specify in the problem. Okay. So opening balance as on 31st December 20x7. Prior year adjustment as per International Accounting Standard 8. So we will have to come to that. What is a prior year adjustment? That means if we have to make any adjustments to the profits because of earlier year's transactions, that will be adjusted. And then we get what is called as a restated balance. That is adjusted balance. We can call it as adjusted balance. Out of this now, you will find that dividends are paid. So this dividends is what? This is dividends paid. Okay. So dividends are paid. So you can see that dividends are paid out of retained earnings. So it is why it is put in bracket. Bracket means minus. So out of the profits, you are paying dividends. So dividends paid will reduce your profits and your total equity will also reduce. Issue of share capital. Shares are issued. What happens? Your share capital increases. So it is added over here. If it is issued at premium, then share premium will also increase. Okay. Suppose your shares are of par value $10. You are issuing at $15 per share. So $10 per share, that will come under share capital. $5 per share, that will come under share premium. And the total of this will come in the total equity. Okay. Now, then you have total comprehensive income, which is coming from your statement of profit or loss. Just like when you prepare final accounts, at the end you write profit, net profit carried forward. Correct now? And then you show it in the balance sheet. So here what we do, we write net profit carried forward and you bring it in the statement of changes in equity. Okay. So that it will be adding to whatever part of that is a part of revaluation surplus, that will add to revaluation surplus. The balance will add to retained earnings and it will increase. Then sometimes we may have a transfer to retained earnings from revaluation surplus. This we will see in chapter number 2 when we are doing IAS 16, property, plant and equipment. When is revaluation surplus transferred from there to the retained earnings? You can see that revaluation surplus, it is showing a minus. That means it is taken out from there. Retained earnings, it is showing add. That means it is added to the retained earnings. And then we get the final closing balance on 31st December 2018. Okay. Any difficulty? Anything that you don't understand now, always feel free to ask. I don't mind explaining 2 times, but objective is that you have to understand. Okay. So that was as far as the balance sheet and statement of changes were concerned. Now we come to statement of profit or loss and other comprehensive income. Normally, we don't prepare 2 separate statements for profit and loss and comprehensive income. We show it in one single statement. Now, the question is, what all things will come under other comprehensive income? Under other comprehensive income, because that is also an extension of the statement of profit or loss. So why we show certain items in profit or loss? Why we show certain items in the OCI or other comprehensive income? That is normally the doubt that students have in their mind. That if we are preparing one statement, why certain items are classified there and certain items classified here. I'll give you a small example. Let us say that you are having land in the balance sheet. Okay. You are having land in the balance sheet. And that is showing a value of $80,000 last year. Now, in the current year, you are told that this value has increased and it has gone up to $90,000, which means that there is an increase in the value of your asset, increase in the value of land, that is increase in the value of asset. Any increase in the value of asset, there is a profit or loss?
Profit.
It's a profit, correct. So now tell me, is that profit actually realized in cash or it is not realized in cash?
Not realized, sir.
Have
not realized in cash.
Not realized in the cash in the sense, have I received that profit of 10,000 or have I not received that profit of 10,000? See, value of land has increased now. So you are going to add 10,000 to the balance sheet land value and increase it to 90,000. Now that 10,000 is a profit, I have to show it in the profit. So is it a profit which I have received actually in cash?
No,
or
sir.
only a book entry?
It,
Have I received it in cash or is it only a book entry?
only book entries.
Absolutely right. It is only a book entry. I have not realized in cash. Why? Because I have not sold the land. I have not sold the land. I'm just revaluing the land. That last year the value was $80,000. This year it has increased by $10,000. Value of the land has increased. I have not sold. If land of 80,000 is sold for 90,000, you can say, sir, cash is realized, 10,000 we have got profit. But I have not sold the land. It is only a book entry that I'm increasing the value of land. So it is unrealized profit. This unrealized profit can never be shown in the profit or loss account. Why? Because in the profit or loss, I show only that profit which is actually received or receivable. It is not received. It is only a book entry. So I can't show it in the SOPL. I will show it where? Other comprehensive income, OCI. So certain unrealized gains, I'm once again saying, certain unrealized gains will be shown in the OCI and not in the statement of profit or loss. Okay, so that is why we have the SOPL and OCI. So certain things which cannot be shown there, we'll be showing it in the OCI. Second, I'll give you one more example. Let us say you must have done branch accounts in college. Have you done accounts, branch accounts?
What kind, sir?
In
Branch accounts.
branch accounts, foreign branches, internal branches. Have you done
No,
that?
sir.
Okay.
No, sir.
Let us assume that you are having your head office in India and you have branches in London, in Japan, in Singapore, in US, all these places. Now, at the end of the year, what is going to happen? Your London branch will send you a trial balance and balance sheet. Okay. Normally, they don't send balance sheet, they send you trial balance. Your London branch sends the trial balance and their currency is pound sterling. Your Japanese branch will send the trial balance and their currency is yen. US branch will send their trial balance, their currency is dollar. So likewise, each of your foreign branches are going to send their trial balance in foreign currency. But in India, when you prepare your accounts, you have to convert all those foreign currencies into rupees. So when you convert them into rupees, the trial balance will differ. There will be a difference in the trial balance. The reason being that all the items in the trial balance are not converted at the same rate of exchange. Your opening stock will be converted at the rate of exchange at the beginning of the year. Your closing stock will be converted at the rate which is there at the end of the year. Your expenses and income will be taken at the average rate of the opening and closing stock. So when that happens, all items are not translated or all items are not converted at the same rate. As a result of which there will be a difference in trial balance. So either your credit will be more or your debit will be more. So that will result in foreign exchange gains and losses arising on translation of foreign operations. So is that an actual gain or an actual loss? Answer is no. It is only on translation, on conversion of foreign currency into home currency. I have not made actual profit or actual loss. So it cannot be shown in my statement of profit or loss as my profit or as my loss. It is a book figure. And that may change in the next year also. This year I may show foreign exchange gain. Next year I may show foreign exchange loss. So I will set it off against each other. Okay, so such items are shown in the OCI. Okay, but now these things are not there in detail for your FR syllabus. When you are doing SBR and the after your FR, that is your professional level, when you're going, you have the advanced FR, which we call as strategic business reporting, which is SBR. So in that you will be having all these in detail. But for the time being, you just have to know the items that will come in OCI. Now, items that will come in OCI are of two types. One, which initially will be shown in OCI and later on will be transferred to profit and loss, which we say recycled to profit and loss. Second, which will be shown in OCI from beginning to end. It will never be transferred anywhere else. So accordingly, I have highlighted here items that might be reclassified, items that will not be reclassified. So items that will be reclassified, foreign exchange gains and losses, cash flow hedging arrangements, and remeasurement of debt instruments. Nothing you have to study or mug up over here. Just remember that these three items, if they come, they have to be items which are in OCI, which may be reclassified. Items that will not be reclassified, revaluation surplus. Just remember this term, revaluation surplus. That's enough. Because that is the most important part which will come frequently in your answers. Okay. Presentation of financial statements requires that you prepare either a statement of profit or loss and other comprehensive income, which is a single statement, or a statement of profit or loss showing the realized profit or loss for the period, plus a statement showing other comprehensive income. That means separate statements. Now the formats are given to you. If it is a single statement, how it is done. We have a revenue. This is a single statement, which is showing statement of profit and loss and other comprehensive for the year ended 31st December. Revenue, cost of sales, you have gross profit, then distribution cost, administrative expense, profit from operations, finance cost, investment income, profit before tax, income tax expense, and then you have profit for the year, which is similar to your net profit. And after that, you have this heading coming, other comprehensive income. So it is continuing. It is in the same statement only. See, this is your net profit for the year, net profit or net loss. And after that, we continue just by writing one more heading, that is other comprehensive income. And all those items will come here, gain or loss on devaluation, gain or loss on fair value through other comprehensive income, financial assets, and so on. And the total is called as total comprehensive income for the year. Now, one MCQ that is very likely over here. What is that MCQ? They purposely want to confuse you. So they will say something like this. For example, they will say that income tax expense is a part of other comprehensive income. True or false? What will you say?
False, sir.
It is false. But suppose I say income tax expense is a part of total comprehensive income. Is it true or false?
True, sir.
It is true. Because total comprehensive income is net profit for the year plus all these things. Okay. So income tax expense is a part of this figure because it is including the profit for the year and it has been adjusted. But it is not a part of OCI. It is not a part of other comprehensive income. So you have to understand the difference between other comprehensive income and total comprehensive income. Okay. Total comprehensive income is net profit for the year plus OCI. Total comprehensive income. How did you get total comprehensive income? It is your net profit for the year, or net profit simply after tax plus the OCI. So I will just write this equation here. Total comprehensive income is equal to net profit for the year plus OCI. Is that clear? Now, alternative presentation they have given. This is where you prepare two separate statements. So what has happened? Same statement, we cut off at the profit for the year part. Okay. And then we have a separate statement, which is called statement of other comprehensive income. And this particular profit for the year, we again write it over here. We bring down the balance. And we then write other comprehensive income and show it. So it is only that there are two separate statements here. There it is shown as one single statement. That is the only difference. Normally, we don't show two separate statements. We show it as one single statement. Okay. Now, I'll come to this preparation of financial statements at a later stage. Let me come to chapter number 5 now. Preparation of financial statements I'll do after I finish. Sorry, not 5, but I'll take chapter number 6 and 7. I'll complete and then I'll come back to that. Conceptual regulatory framework. It's 1 minute. Okay. Need for a regulatory framework. What is the need or the requirement of a regulatory framework? Basically, we are now talking about not only the financial statements, but a regulatory framework that is required for financial statements. Now, when we talk about this, the question comes, why do we require a regulatory framework, first of all? See, every set of financial statements must be prepared in a particular format. Now, if you are having a format in India, for example, in India, we have trading account, profit and loss account, then profit and loss appropriation account. Then we have balance sheet, which is in the statement form, which is assets and liabilities. Left-hand side is the liabilities, right-hand side is the asset. Okay, like that, we are having our own format of financial statements. Suppose now an Indian company goes to foreign countries and opens branches over there, or opens subsidiary companies over there. At the end of the year, we have to consolidate all the accounts wherever your branches are and prepare one single set of accounts. Now, suppose I open a company in Germany and I prepare trading account, profit and loss account, balance sheet over there as per Indian accounting formats and Indian accounting standards. Now, in my German company, the people who have invested are Germans. They are not Indians. Okay. And in Germany, they are having their own set of rules and regulations, which are different from Indian accounting standards. So when they interpret something in the financial statement, it is different from what we are interpreting. So they will get a different meaning out of that. I will assume that they have understood it in Indian sense, but they have understood in a totally different way. So in that case, there will be a misunderstanding, there will be misinterpretation of financial statements by investors in Germany and investors in India. So how to make a set of financial statements which can be understood by Germans also, which can be understood by Indians also, and which can be understood by any person anywhere in the world. So for that purpose, we should have common set of rules and regulations for preparing financial statements all over the world. But is that possible? That is not possible. The reason being that every country has its own company law. In India, we have Indian Companies Act of 2013, which we are following. So it has got its own rules and regulations. In China, they have got a different Companies Act. In US, they have got a different Companies Act, company law. So the company law itself of different states, different countries, they differ. Plus the rule of the land, the criminal law, the civil law, they are all different in India, they are all different in US. So how can you expect financial statements to be prepared with the same rules and regulations? So we have something called as International Financial Reporting Standards, that is IFRS. Now, IFRS, when they have framed IFRS, it was framed from the point of view of all countries, that all countries who are setting up businesses in other countries and having MNCs, multinational corporations, they should be following the IFRS, the International Financial Reporting Standards, so that their financial statements can be seen, read, and interpreted in the same way by a person sitting in China or Germany or Japan or Singapore. He will have the same understanding of the financial statements. IFRS came into existence, but then application of that. America said, we are not going to implement IFRS because we are having our own US GAAP. America has got its own US GAAP. That is, US GAAP means what? Generally accepted accounting principles. So America said, we don't want your IFRS. We are going to follow our own US GAAP. All other countries said, okay, we will continue with IFRS. We will implement IFRS, but we cannot implement IFRS 100%. As I told you, because there are differences, there are cultural differences, there are transactional differences, there are monetary differences, there are currency differences, there are so many differences. So all the countries said we will agree to IFRS and we will try to bring our own country's laws on par with IFRS, if not 100%, to whatever extent possible. We will align them. So there is a difference in aligning and merging. There is no merger. We have not given up our Indian laws, but we have said we will frame our Indian laws in alignment with the IFRS. So there is some similarity. So when our financial statements are prepared, they can be understood at least to the extent of 90%, 95% by other people. So what was the need for this regulatory framework? The need was because every company, every country had its own company law. The European Union was formed, where the European Union had its own set of directives, had their own currency, which was called euro, right? German did not have their own, that Deutschmark was the currency of Germany. That Deutschmark was gone, euro was implemented. So all the countries, Italy, France, then your German, all these companies, Germany, all these countries, they followed one single currency, that is euro. And that is because they had these EU directives. EU is European Union directives. It said that all countries in the European nation, they have to follow the same rules and regulations. Okay, so there were some differences in countries. For example, America had SEC. What is SEC? Securities Exchange Commission. Securities Exchange Commission. Like we have SEBI in India. You have heard about SEBI, no? So SEBI is there in India. So like that, they have got SEC, Securities Exchange Commission. So all these were now to be brought on par with IFRS. So therefore, a regulatory framework was required because every country had its own set of rules and regulations. What is the immediate need for having a regulatory framework? The immediate need for having a regulatory framework is that we should be able to prepare our financial statements, at least that the readers of the financial statements, the users of the financial statements, I've underlined over there. What is written there? Receive a minimum amount of information. I'm not saying that 100% that person should be able to understand, but at least minimum amount, the basic information that he wants, like if he wants to calculate the current ratio or if he wants to interpret the debt equity ratio, you should be able to do that. So receive a minimum amount of information that will enable them to make meaningful decisions regarding their interest in the reporting entity. That is the purpose of having a regulatory framework. Accounting standards on their own would not be a complete regulatory framework. In order to fully regulate the preparation of financial statements and the obligations of companies and directors, legal and market regulations are also required. So not only accounting standards, not only IFRS, but we need to have backing of the country's laws. So in India, if you don't have some law which makes it compulsory for companies to follow the IFRS or the international accounting standards, nobody will follow. So the government will say, okay, if you have to file your income tax returns, file it in the way in which all the financial statements are based on the IFRS. Okay. So until and unless you have a law backing the accounting standards, by itself, accounting standards cannot be enforced. They are not legal. It's just a framework. It's just a format that is given to you. It is not compulsory. Now, to make it compulsory, we should have laws which are backing that. So SEBI will make the necessary changes. Income tax department will make the necessary changes, right? Your stock exchanges will make the necessary changes that if you want to list on the stock exchange, you have to have your financial statements in this particular format. So until and unless you do that, people are not going to follow what is not compulsory. Now, the framework can be of two types: a principle-based framework and a rule-based framework. Now, what is the difference in the two? The difference in the two is, I'll give you a small example. Let us say I'm sitting in the office here of ISDC, and when I'm sitting in the office here, my timings are, when I was appointed, I was told, Prabodh sir, your job is from 9 to 5. So I say, okay, 9 to 5. At the dot of 5, I close my laptop, I pack my bag, and I start to go. My reporting manager comes and asks me, have you completed the work that I given to you? I said, no, ma'am, I have not completed. I will complete it tomorrow, but today it is now 5 o'clock. I'm going home. I'm getting late. What is that? That is rule-based working. I'm appointed from 9 to 5. So as soon as it is 5 o'clock, I wind up. I don't work beyond 5 o'clock. Rule-based working. Principle-based working, I will say, okay, I have not completed. I will finish it. Is it urgent? She says, yes, it is urgent. I will sit here, complete the work. Even if it is 7 o'clock, 8 o'clock, I will finish and then leave. That is principle-based work. Right? So, suppose now, let us take your example. Today you got late for the lecture. You said, sir, I'm getting late. So I will be able to reach only by 2:30. I said, no, it is not possible. 2 o'clock is the time. If you are not able to come, I'll cancel the lecture. That is rule-based. Where there is no flexibility. But I told you what, okay, fine. Whenever you reach, if you are able to make it, let us have the lecture. But I told you my restrictions also. I cannot go beyond 4 o'clock because I'm having another session here. So you said, okay, sir, I'll come try to reach by 2:30. We can start by 2:30. So there is flexibility. That is principle based. So when I say principle based, principle means what? That what is the actual need of the hour? I will adjust according to that. Now, there was a culture in my office only, I'm telling you here also, in my office only, here at ISTC. After 5 o'clock, people never used to pick up phone calls of office colleagues. They will pick up phone calls of friends. Office colleagues, they will not pick up the phone calls. They will not answer the messages. They will read the messages, but they will not answer the messages. Why? Because it is official work. Beyond 5 o'clock, we don't work. So they were doing rule-based work. Now it used to so happen. And when employees on leave, when I say that I want to leave, I will not come tomorrow. Tomorrow, I will not pick up any call from the office or receive any message from the office. And if I have a different office phone number, I will put it on off mode, switch off. Now, suppose office catches fire also, I'm not bothered. Why? Because I'm not working. That is rule-based approach. So what used to happen was, I used to have lectures on Saturday and Sunday. And Sunday, most of my colleagues are on leave. The coordinators are on leave. The faculties, most of them are on leave. Only those who are having lectures on Saturday, Sunday, they will be working. But it so happened that on Sunday, I was not able to log in for a particular session. It was an online session and I was not able to log in. I called up my coordinator 10 times. Coordinator did not pick the call. I messaged the coordinator. Coordinator saw the messages, on WhatsApp and get the blue tick. That blue tick used to come. That means coordinator has seen the message, but coordinator will not respond. So then I tried a lot of times from my side. And I said, okay, if the coordinator and ISDC is not concerned, why should I be concerned? I canceled the lecture. Lecture got cancelled. Next day, I got a call. Why did you cancel the lecture? Then I explained to them the difference between rule-based working and principle-based working. That since we are doing rule-based working, I had to cancel the work because I was working on principle base. I tried to approach you, I tried to call you, but you are not picking up the call. You are looking at my messages, not answering. They said, we are on leave. I said, fine, then I will also go on leave. Why should I be working? Now everybody has come online. At least my messages, I get responses on Sunday also, holidays also. So that is the difference. See, when you are a professional, I'll tell you one thing. When you are a professional, there is a difference between a professional and an employee. Employee will work from 9 to 5. But if I am a professional, I don't have timings. Chartered accountant will not have timings. Have you ever seen a chartered accountant winding up at 5 o'clock and going? No. They will sit late nights also. Have you seen a lawyer winding up and going? No. They will sit late nights. They have to work. So professional people, doctors, sometimes they finish their duty, they go home, they get an emergency call. When they say that, no, my duty is over, No, they have to come. So professionals don't have timings. We should be available as and when we are required. That is because we are working on principle-based framework, where there should be flexibility. So if I'm working on Sunday, I've told them, if I'm working on Sunday, I should get a weekday off. They said, fine. Because that is compensating my Sunday holiday. That is principle-based framework. But if you say no, Sunday also you have to work, weekdays also you have to work. If the work comes on Sunday, you have to work on Sunday. You can't cancel the weekday lecture. Then it becomes difficult. So we have to do some adjustment. So that is the difference between principle-based and rule-based. Rule-based framework is also called as cookbook approach. Now, what is the meaning of cookbook approach? Suppose we are preparing a dish by looking at a recipe book, or you have been watching some cookery show, chef special. From there, you are preparing your food. Now, in that recipe book or from the show that you are watching and preparing the dish, they forgot to mention that you had to put salt. And since they forgot, you also did not put salt. Now, when you tasted the food, everybody said there is no salt in that. What will you tell them? Anyway, in the show, they did not tell me to put salt. So I did not put salt. That is rule book, cookbook approach. Okay. So principle-based framework, you will say, okay, he has forgotten, but this is not tasting good, so let me put salt. That is principle-based framework. That is a difference. So principle-based, flexibility is there. Rule-based, it is rigid. Okay, so word that is going to be used over here. For principle-based, I will say flexible. And for rule-based, I will say rigid. Okay, so this is the difference between the two approaches. Now, in UK, there is a principle-based framework. You are doing ACCA, you are related to UK. So in UK, they have got a principle-based framework, which is flexible. So for that, they have got something called as concepts. That is conceptual framework, which we'll come to in a few minutes. In the UK, there is a principle-based framework called as concepts and pervasive principles contained within FRS 102 and a rule-based framework in terms of Companies Act. Now, we have a concept called harmonization. Harmonization means bringing everything on par. As I told you, different countries have different laws. So to harmonize all the activities, make everything go smoothly, you have to get everything on par. So for for companies which are having multiple branches, multinational branches, when you are preparing financial statements, until and unless there is harmony means a smooth flow of understanding of your financial statements, it will be difficult to understand the financial statements. In case of investors, for example, if I want a loan in dollars, then what are the rules and regulations of that country? I should know. Are they similar to my country's rules and regulations? Are they matching with my country's rules and regulations? So I have to see that harmonization. So for the investors, where to invest, in what currency to invest, for that purpose, we require harmonization. For tax authorities, certain transactions, for example, I earn rent from a property in London. I earn rent from a property in London, but I am an Indian citizen. So what will happen if in London they tax my income there And in India also, they tax my income, saying that you are earning income from foreign country. I will have to pay double tax. So harmonization, bringing about a parity that if I'm taxed over there, I will be exempt over here. If I'm taxed in India, I will be exempt over there. There should be some harmonization. So that is the benefit of harmonization. Disadvantages, difficult to introduce because it is difficult to enforce in different countries. Different legal systems, as I told you, different company laws which are there, different purpose of financial reporting, different types of transactions. And I was just mentioning this to my previous batch, where I said that if you look at digital transactions in India, the number of digital transactions in India is the highest in the world. The highest in the world. It is equal to 3 European nations' transactions, the volume of transactions. So obviously, we will require a different type of accounting system because most of our payments are digitalized. Transfer of funds, electronic transfer of funds. Now, how many times we make use of our mobile phones to scan a QR code and make the payment? When I was in Hyderabad, I found that during this pandemic, all this digitalization started, digital payments. And during 2021, I was in Hyderabad. When I used to go out, during the day, the only shops that were open there were tea stalls or some eateries were open. So when I used to go out, I used to find that even for a 10 rupee cup of tea, people used to pay by scanning the code, which meant that digitalization or digital payments had become so rampant, so widely used that every Tom, Dick, and Harry, for whatever amount, whatsoever small or big the amount is, used to make digital payment. I had some repair works in Bombay, and a contractor was appointed to do the repairs of my house. He said, "Sir, 1 lakh will be the cost of the repairs." I said, "Fine, you go ahead." Earlier days, what we used to do, we used to write a check. I told him, "You have a GPay account?" He said, "Yes, sir." I asked him for his GPay number, transferred 1 lakh from here to there, matter was closed. So all digital payments, all types of expenses are now having digital payments. So the nature of transactions in India has changed. And if you have ever been watching television, you will find an incident that our External Affairs Minister Jaishankar gave. Immediately after pandemic, Jaishankar went to America. His son is in America. And he and his son were going for a function, for an event. And at the entrance there, they were asked to show that they are fully vaccinated, the certificate of vaccination, COVID vaccination. Jaishankar said, "I removed my mobile phone and I showed my Arogya Setu app. On that, it was my certificate had come, fully vaccinated. But my son removed his wallet. Out of that wallet, he removed a piece of paper and he showed that piece of paper. That piece of paper had crumpled." What do you mean by that? It means that in America, they are still following that piece of paper as a proof for vaccination. In India, we have gone on apps, digital apps. So India has made so much of progress in the last few years that it has literally overtaken all the Western countries. And we should understand this because we are more tech-savvy people. In India, we are more tech-savvy people. So any technology that comes, we adopt it first in our practical day-to-day life. So there are disadvantages of harmonization also because laws are different. Now, for example, Twitter laws. We have a lot of problems on Twitter because a lot of fake news is being spread. So our Indian laws don't permit that. So we ask Twitter to, detail or rather delete certain comments because it is not suitable to Indian laws. So laws are different because every country has its own set of rules and regulations. So there will be a small hurdle, a small disadvantage when you're going to harmonize everything and going to make everything on par. Okay, so these are the advantages and disadvantages. Role of national standard setters. Every country has its own regulating body. In India, we have SEBI for all stock exchange related transactions. We have the ICA and the ASB, that is Accounting Standards Board, for preparing all accounting standards which are relating to financial statements preparation, for laying down all rules and regulations for internal and external audit. So these are the regulatory bodies. Now, if you have to implement IFRS in India, Prime Minister can't do it. You have to go to the Ministry of Corporate Affairs in India. You have to go to ICAI, the body of chartered accountants. You have to go to SEBI and ask them to make the necessary changes. Now, these people are called as the national standard setters. So, who's going to bring the country's laws on par with IFRS? These national standard setters. So the national standard setters of all the countries, they come together and they say that in order to align all our countries' laws with the international rules and regulations, what changes we need to. So India also switched over from Ind AS, that is Indian Accounting Standards, to IFRS. Most of the Indian accounting standards are on par with IFRS now. Some are different because of the nature of transactions that we have, which differ from international transactions. So I've underlined over there, national standard setters are committed to a framework of accounting standards based on IFRS standards. So in whichever country you are, you will be setting your accounting standards in such a manner that they align with the international accounting standards. Now, the different accounting bodies that we are having, you can just go through this. It's not that important. The IFRS Foundation, for example, it is a supervisory body. Now, you have to know the role of each one of them. It is not that they are not important. The IFRS Foundation, it is a supervisory body. It is responsible for governance issues. Objectives are developing a set of global accounting standards, promoting the use and application of the global accounting standards that we are calling it as IFRS, and bringing about the convergence. Convergence means meeting point, alignment of the national and international accounting standards. That is the job of the IFRS Foundation. International Accounting Standards Board, that is IASB. In India, we have ASB, Accounting Standard Board. International Accounting Standard Board is IASB. They are responsible for implementation and issuing of IFRS. This board is made up of whom? It is made up of all the national standard setters of every country. They are coming together and their grouping is called as the International Accounting Standards Board. Okay. So they are the group of national standard setters. IFRIC, International Financial Reporting Interpretations Committee, issues rapid guidance on accounting matters where divergent interpretations are existent. For example, there is an accounting standard or an IFRS which is ambiguous in nature or which can have more than one interpretation. That is clarified by this committee. That is why it is called Interpretations Committee, IFR, International Financial Reporting Interpretation Committee. Okay. Newly identified financial reporting issues not specifically dealt with in IFRS. So suppose now, for example, till a few years back, we did not have this digital payments. So how to account for digital payments? There was no accounting standard for it. So these are new issues which are coming up. Now we have cryptocurrencies coming up. How to account for cryptocurrency, whether it is an asset, whether it is a liability, whether it is an income, whether it is an expenditure. we have to define this first. So for that, you require an accounting standard. So newly financial reporting issues which are coming up, they are dealt with by IFRS. If not, if there is no accounting standard, then they are dealt with by the IFRIC, that is the Interpretations Committee. Then we have the Advisory Council. Advisory Council advises the board on the agenda decisions and priorities in the board's work, informing the board of the views of the organizations and individuals of the council, and giving other advice on the board or to the trustees. Now, development of an IFRS standard. This is very important for you. Because they may ask you a question on how an IFRS standard comes into existence. What is the procedure involved? Okay. The procedure for the development of an IFRS standard is as follows. The board identifies a subject and appoints an advisory committee to advise on the issues. For example, now the board has identified the subject of cryptocurrency and disclosure of cryptocurrency in financial statements. So it has identified the problem. So it has appointed an advisory committee to advise as to how this should be represented in the financial statements. The second step is board will issue a discussion paper to encourage comments. So since I am a CPA now, I have also got a letter from the board saying that if I have any suggestions as to, like that all the members are given the letters, that if we have any suggestions to offer as to what should be the right way in which cryptocurrencies should be disclosed in the financial statements, we can give our opinion on that. So a discussion paper is invited. Third step, the board publishes an exposure draft, which is a draft version of the intended standard, taking all our inputs. They will prepare a draft paper that is a rough outline of what the accounting standard should be looking like. So that is what is an exposure draft. Following the consideration of comments received on the draft, whether any changes have to be made, we say that, okay, no, this wording is not correct. Replace this word by another word. So they will make the changes on the recommendations given by us again to the draft. And then finally, the publication of an IFRS standard, the exposure draft or IFRIC interpretation requires the votes of at least 8 out of the 15 board members. Then it becomes a IFRS, that is a International Financial Reporting Standard. Okay. So the steps which are involved, that is important for you to learn. So there are 5 steps. All those 5 steps we have to learn in order. Now we have something called as conceptual framework. Very important. And the basics of this will be actually, literally grinded in every question. So every question will expect you to have full knowledge of the conceptual framework. Now, what is a conceptual framework? A conceptual framework is a coherent system of interrelated objectives and fundamental principles, which prescribes the nature, function, and limits of financial accounting and financial statements. In simple terms, what is a conceptual framework? A conceptual framework is nothing but an Oxford dictionary for English language. It is on par with that. So suppose you are reading a book and you come across a difficult word. Where will you go? Whom will you refer to? Suppose you ask your friend, he does not know. You ask your parents, they don't know. Whom will you refer to? Now you are having Uncle Google. But before Uncle Google was born, you had nobody else but the Oxford dictionary. So you will go to the Oxford dictionary, open the dictionary, find out the meaning of the word. So that was your base. from where you learn your language. Accounting language will also have certain words, certain terms, which are difficult to understand, which are difficult to interpret, or there may be more than one interpretation. So what is the right interpretation of that particular concept? How will you come to? Because accounting standard gives you the standard and finishes. It does not explain. So if you want the explanation, you'll have to refer to the base. What is the base? The conceptual framework. So your conceptual framework is to you what an Oxford dictionary is to your English language. So it will help you to understand all technical jargons, all financial jargons, which are mentioned in the accounting standards, the interpretation of which may be more than one, and what is the right interpretation for your financial statements. That is given in the conceptual framework. Now, coherent, I have given you the meaning over there. It is capacity to hold together or bind. So interrelated objectives, to bind them together and have a base. That is your conceptual framework. Okay. Any questions you want to ask? Everything is clear? We'll stop here for today. I think tomorrow again we are having a session. It is 2 to 4, 2 to 3:30 tomorrow, right? So we'll
Yes, sir.
at 2 o'clock. 2 o'clock, I suppose we will not have anything else again tomorrow in the college.
Nothing, sir. I hope not.
Okay.
Today they mentioned to us during the last period, sir, that there is a meeting.
Okay. I know, because it's the first day of your college now. It's your opening day of the college, so they will have all these meetings. I think in the morning also you get some principal's address or something, the first lecture.
Yes. Yes.
So, okay, it's fine. So tomorrow at 2 o'clock, in fact, tomorrow I will be here only because I'm having lectures in your college tomorrow. Tomorrow I'm having first lecture with the, I think, final year students for AFM. And then I'll be coming back to FR, that is the second year students. So I'll be in your college, I think, up to 12:30. And after that, I will be.
Yes.
Fine? Okay.
Okay.
Yeah.
Thank you, sir. Bye, sir.